There are two dates that changed the United States dollar forever: 1971 and 1985. In 1971, President Richard Nixon took the dollar off of the gold standard temporarily, which meant our dollars, what we call money, went from being backed by physical gold to being backed by the government, saying that our dollars have value.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
It's been over 5 decades, and we're still waiting for this temporary program to end. But things changed again in 1985 when the United States switched from being the largest creditor nation in the world to the largest debtor nation in the world. Prior to 1985, the United States was the largest creditor nation in the world, meaning countries around the world came to the United States to borrow money, and we were essentially the world's bank. We would lend people money because we had the assets and the ability to lend other countries money. But then in 1985, it flipped. We then became the largest debtor nation in the world, meaning we now borrowed more money from countries around the world than anywhere else. We went from being the bank to now being the person in credit card debt. Now, all this borrowing the United States government is doing isn't a big deal yet, because we are the world's reserve currency. And to understand what this means, you have to understand how our economic system works, because our economic system runs on spending. The more money you spend, the more money somebody else makes, and the more jobs that are created. The less money you spend, the less money somebody else makes, and the less jobs there are. If you have $100 in your pocket and then you put it in your savings account and you do nothing with it, that does not stimulate the economy. But now if you take the $100 and you take a few of your friends, you go to Sweetgreens, you go and get some salads, now you took the $100 and you stimulated the economic system. But now let's do this a third time. If you took the $100 in your pocket, you took a handful of your friends, now you go to Sweetgreens, you upgrade, you get the double meat, you get everything there, and now you spend $200 because now you also put it on your credit card. You just stimulated the economy even more because now Sweetgreen made more money. They have the ability to hire more employees, open more stores, and continue building their operations because now the business is making more money. When more money is spent in our economic system, businesses have the ability to earn more money. When they earn more money, they have the ability to invest in more stores, in more infrastructure, in more innovation. That means they hire more people, they invest in more softwares, more people have jobs, the economy is able to grow. And who is the largest spender here in the United States? Well, none other than the United States government. And how does our United States government get the money that they want to spend? Well, if you're thinking taxes, you're right, but I want you to hold that thought. Because in 2022, the United States government brought in $4.9 trillion in taxes. But they didn't spend $4.9 trillion or under $4.9 trillion. They spent $6.3 trillion in our economic system. Which means, where did they get this extra $1.4 trillion? Now, what we do know is that the extra $1.4 trillion that they spent help stimulate the system, because our United States government is spending money places. Where do they spend money? Well, they hire construction companies to build bridges and to build roads. They pay for teachers. They pay for police officers. They pay for firemen and firewomen. They pay for all these different things, and they create jobs. In fact, you might think that efficiency is a good thing. And it is if you're running a for-profit business. But when you are a government with the sole goal of creating jobs, inefficiency is even better. Because now if you can create an inefficient system where now you have 10 people employed to do what 3 people can do, from the government's perspective, you just created 7 additional jobs. Now, if you're a business, you're going to say that's a waste of money because, well, I could have done that same job with 3 people and take that extra money and put it somewhere else. But from a job creation perspective, inefficiency does a good job at creating more jobs. So businesses are always working to create efficient systems. The government isn't always working to create inefficient systems, but they're also not always incentivized to create efficient systems. The government might be more incentivized to go out and create jobs, and sometimes the way that they create jobs might not be the more efficient system. As while I'm on this topic, I also want to kind of say this little tangent. Do you want to guess now? What is the biggest asset on the United States government's books? Take a guess. Well, it's you, but not all of you. It's those of you that are in debt to the United States government. It's those of you who have student loans. Student loans are the number one asset for the United States government. And if you don't believe me, just go to Google and search the biggest asset for the United States government, and it'll pop up for you over there. The United States government needs its citizens, it needs its people to go out and, number one, be in debt to the government. That way they can continue funding their operations. And then number two, they need people to continue going out and spending money because that continues to grow the economic system. And then three, they need people to continue paying taxes because that funds all the government spending. But now coming back to the United States being the largest debtor nation in the world, when the United States spends $1.4 trillion that they don't have, what does that mean? There has to be a cost to this, right? I mean, if the government can just borrow or print as much money as they wanted, why do we have to pay taxes in the first place, right? Well, there is a cost, and that cost is inflation. See, when the government goes out and they borrow money or they print money and then they spend this money, this creates an economic boom. Because now if the government can go out and create more jobs, they can go out and spend it in our economy, more people have money. Because now all of a sudden the government's going to be investing in new contracting companies. They're going to invest in new defense companies. They're going to invest in new green energy companies. They will throw money around into these companies, which means now companies have more money. They can hire more employees. They can raise people's salaries, and that can create an economic boom, which is good on the short term. But there's a cost to this. There's a cost to the government now creating money or pumping money into the system, and that cost is inflation. Because now if the government could just print an infinite amount of money, they could give everybody a $100,000 check. And if everybody got a $100,000 check, everybody could go stand in line at the Ferrari dealership and go out and buy a Ferrari. Maybe not a brand new Ferrari, but some sort of used Ferrari. Now, it doesn't take a rocket scientist to figure out that if everybody had $100,000 to go out and buy a Ferrari, Ferrari prices are going to rise. Why would Ferrari prices rise if everybody could afford a Ferrari? Well, when you go out and create this type of money, the value of each individual dollar goes down, which in turn causes the price of things to go up. This is what inflation is. Inflation comes from the word inflate. And what are you inflating when you have inflation? Well, in this case, you're inflating the monetary supply. When you increase the amount of dollars out there, the value of each individual dollar goes down, the buying power of your savings goes down, the buying power of your earnings go down, which in turn causes the price of things to go up. That's what inflation is. So now when the government spends more money than what they bring in, whether it's through debt, whether it's through printing money, that then creates an economic boom. And over the last number of years, we have been seeing the economy boom very quickly because of the amount of money that entered the economic system. So on one hand, this is good. An economic boom can allow people to earn more money, it can allow businesses to grow, and it can allow growth in the economy. That's good. But then the downfall and the risk is inflation. And in the past, when we saw a lot of money printing happen in 2008, when we saw a lot of money printing happen in 2000, it wasn't that big of a deal because we never saw the real effect of inflation. Now, of course, if we didn't print the money that we did in 2008 and 2000, we would have saw even less inflation and less price growth than we saw already. But we didn't see a very painful amount of inflation to really cause significant pain. Then after the 2020 pandemic, after the 2020 and 2021 money printing, after the quantitative easing, after all the stimulus programs that were done, not just for people through stimulus checks and unemployment checks, but also for businesses that happened across the board, this created a whole new influx of trillions of dollars to the like that we have never seen before. This then kind of imploded the whole inflation system that we have seen now. We saw inflation go to some of the highest levels that we have seen in 5 decades, and now we are actively working to bring inflation down. But there's a hidden issue here and a hidden concern here, which is if the dollar is not backed by any precious metal, if it's a fiat currency means it's backed by the government and it's backed by a promise that our dollars have value. Well, is there a limit? Could there ever be a time where we print too much money? Could there ever be a time where now we have done too much? We have too much inflation, and then what happens? I mean, if you really think about it and do the math, it becomes very interesting because it costs 12 cents for the government to print a $100 bill, which means that we can print a ton of money. It doesn't cost us money to create money, and then we use this newly created money to then give jobs, to hire people, and to buy businesses to do things. But then people have to believe that this money continues to have value. And is there ever a point when people realize, oh, maybe this paper money isn't as valuable as I once thought? Again, the fortunate thing that we have right now here in the United States is that we are the world's reserve currency, which gives us the ability to spend and borrow way more money than other countries in the world because everybody in the world wants to own dollars. Even Warren Buffett talked about this in his latest shareholder meeting. What he said was, we, the United States, are the reserve currency. I see no option for any other currency to be the reserve currency. That's the good news for where our economy is today. But our economy isn't a static image. Things are always changing and things are always conforming. Because then Warren Buffett went on to also say, it's very hard to see how you recover once you let the genie, the inflation genie, out of the bottle and people lose faith in the currency. So yes, we are the world's reserve currency today. There are no other options for the world's reserve currency. Nobody can compete against the dollar today. But if inflation continues to stay a problem, if people start to lose faith in the dollar, if people start to lose faith in the United States currency, well, then things can change very quickly. And that's the concern that Warren Buffett is talking about. And that's the issue with if we continue to go down this route of being the largest debtor nation, continuing to spend way more than what we bring in, continuing to print a lot of money, and continuing to face high inflation. All of these things then cause people to lose faith in their own currency. This is not the first time we've seen this happen with the United States dollar. Ray Dalio wrote an amazing book called The Changing World Order, where he talks about different times in history going back to the ancient Roman Empire, of how you see the same things happen across empires, across civilizations, where you start with a currency that's backed by metal, and then the economy, the government, then starts to debase that currency. If you go back to the ancient Roman Empire, they used to operate on metal coins, things like silver. And then they started debasing their physical silver. The way that they did that with physical metals was they started mixing the silver with other cheaper compounds. And at first, it creates an economic boom. The government wanted to invest in more infrastructure. So then they started debasing their silver, mixing it with other cheaper metals, and then distributing it. Again, good in the short term. But then people said, I need more money. People started demanding more currency. And this continued on and on and on until eventually the currency essentially became worthless. And that was one of the causes of the collapse of the Roman Empire. Now, is that the only thing? Of course not. There's a lot of different factors at play here. But it's a very similar story across civilization, across empire, across countries, where now you create a currency, you start printing a lot of this currency without now that metal, which means now you're essentially printing wealth, which creates a economic boom, which benefits everybody. Everybody feels rich, everybody gets fat, everybody's having a good time. And then eventually you print a little bit too much, and then that starts the downfall. And that's the situation now where if the United States continues to print money, if we continue to spend money that we don't have, if we continue to inflate the value of our dollar, that is going to create long-term pain. And this is where now your job is not to be freaking out about this. This is not something that happens in overnight or even in 6 months. This is a very slow process, but this is something you want to understand. And this is something that now you, as a financially smart person, as a financially educated person, want to make sure that you're taking care of your family and yourself, because no matter what happens, you want to make sure that you are protected. And that starts with you being financially educated. Now, of course, we have been covering everything that's going on with our currency and the economy in Market Briefs. Market Briefs is my free daily financial newsletter where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, the Fed, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to stay up to date on what's happening in the financial markets, Market Briefs is an easy way for you to do that. And I'll put the link to how you can join for free down in the description below. There are 4 main phases that you see when a currency enters decline. Number 1 is when a currency moves away from being backed by something physical. We saw this happen in 1971 when we temporarily separated ourselves from the physical gold. Phase 2 is when you as a country shift from being a creditor, meaning you're loaning other countries and other people money, to being a debtor, where now you're relying on other countries and other people to give you money. That happened to the United States in 1985. Phase 3 is when overspending becomes a part of your culture, and then people and your citizens become reliant on this free and cheap money, and now you have to keep stimulating and keep growing the economy by producing more of this currency, aka printing more of this money. This became very apparent after 2020. And then comes phase 4, when you see countries around the world and the people using that currency want to distance themselves from that currency because they're worried about the decline in the value of that currency. This is now where once we start to see this happen even more, when you see more and more countries start to distance themselves from the currency, which we're starting to see happen now, but we haven't seen now citizens start to back away and move away from the currency yet. But if that were to happen, then you would see a lot more issues and huge inflation, because then people would start to lose faith in the dollar. We haven't hit this completely yet, but this is now that concern where we have already shifted away from gold. We've become a major debtor. We've become so reliant on this free and cheap money. And this is where now you have to keep an eye on people's trust and faith in the currency, because now at the same time, we're seeing countries around the world start to distance themselves from the dollar. Now, this is where you have some people saying, oh, it's not that significant yet. But sure, maybe it's not that significant yet, but you have to pay attention to the trends of what's been happening over the last number of years. Right now, what we're seeing happen is that more and more countries around the world are trying to ditch the dollar as their means of exchange. And it all started when the United States started to sanction Russia when Russia invaded and attacked Ukraine. When Russia launched their attack on Ukraine, obviously this was a hideous act. But then the United States decided that they wanted to punish Russia because they did not like what Russia did. And what the United States did was they froze Russia's assets. And as soon as the United States did that, this created a little bit of shockwaves and red flags to other countries around the world that if you do something that the United States does not like, we, as the elder brother or the older parent, will punish you, and we might freeze your money that's held in dollars. So that created almost like a warning for other countries that, oh, if we keep our assets in dollars and we do something the United States doesn't like, that could come back to bite us. After that happened, we saw China move to buy oil with the yuan instead of the dollar. Now, you might have heard of the dollar being the petrodollar. And what that means is we kind of had this long-standing agreement that if you want to buy oil anywhere in the world, you have to buy oil with the dollar, not at the other currency. Now, that might seem like a really strange thing, but everybody needs oil. It is a major source of energy around the world. So everybody needs to buy oil. And if you're forced to buy oil with the dollar, what does that do? Well, it keeps strength in the dollar, because that means if anybody wants to get oil, they have to convert their currency to the dollar, and then you can use this dollar to go out and buy oil. And if the dollar is that means of exchange for oil, well, that gives a lot of strength and power to the dollar, because if you want to buy oil, you have to use the dollar. And so people have to trust the dollar, because you need that currency in order to get energy. So it created this sense of security and trust. And then just recently, for the first time, we saw now China really working to make moves to buy oil, not with the dollar, but with their own currency, the yuan. Then we saw the move of countries looking to make transactions outside of the dollar. One example was China and Brazil, where if they wanted to trade with one another and sell each other's goods, they had to do that with the United States dollar for the same reason like I just mentioned, because, well, it creates trust in the dollar, and it shows again that if you want something, you have to have the dollar. Well, China and Brazil made an agreement that they no longer had to exchange goods based on the dollar, that they could do it based off of their own currencies. Again, another move to shift away from the dollar. Was this change by itself a major blow for the dollar? No, of course not. But again, it's in the grand scheme of things, and you can start to see the trend where more and more countries are trying to distance themselves from the dollar. Then we saw a move by the BRICS nations, Brazil, Russia, India, China, and South Africa, move to create their own reserve currency. And not just that, there were rumors that said that they want this currency to be backed by physical gold, and we can back that up because recently we have been seeing central banks around the world go out and buy more physical gold than we have seen in the last 5 decades. Why are they doing that? Well, we're seeing countries around the world, like I just talked about, working to create their own currency to potentially create a way to make and exchange goods, to trade goods without having to go through the dollar. Now, in isolation, are any of these things major? No. But what are we seeing happen? We're seeing this trend where the United States moved away from the gold standard. Then the United States went from being a creditor nation to a debtor nation. Then the United States became very reliant on this free and cheap money, low interest rates, and then the United States started to face higher inflation. And then as the United States started to face higher inflation, we started to see major moves by countries around the world. I mean, we're talking about just the last couple of years, everything that I just talked about, where more and more countries are now working to kind of distance themselves from the dollar to potentially create their own currency as well. Now, again, let me make sure that this is clear. The United States today is still the world's largest economy. We still have the world's largest military presence. We still have the world's reserve currency. The United States today still has a lot of benefits. It still has all the powers that the world wants. But we're starting to see these shifts happen in the world where now the trend has been, not just for the last couple of years, but for the last number of decades, the United States being more of an inflationary currency, the dollar, the United States printing more money, the United States becoming more of a debtor. All these things have been building up over the last number of decades, and this is where now, again, your job as a financially educated person is to understand this. That way you can make the best use of your money. Because if the value of your dollar is dropping due to inflation, well, that's where you want to own assets. If the United States dollar continues to see high inflation, and high inflation is really anything over the Federal Reserve Bank's 2% target, you want to make sure you understand what your options are. That way you can convert some of your cash into other assets that will sometimes either benefit or beat out from inflation. That way you can continue to see the value of your money grow, because the last thing that you want to do is just to always save your money and not get any return on your money. Now, the first thing that I want to say is this is not an asset, but if you are saving money, which is okay. There are times and places to save money. There are strategic ways to save money, especially if you're saving your money to take advantage of opportunities like investments at a distressed price. At least consider opening up a high interest savings account. Some high interest savings accounts today are paying upwards of 4%, even close to 5% in interest in FDIC insured banks that do not have to lock up your money. This is not a CD. Your money's not tied up. You can pull your money out whenever you want, but there are some high interest online savings accounts that will allow you to earn a lot more interest on your money. So if you have not done that, that's definitely something for you to consider. There's a ton of high interest savings accounts out there. Make sure it's a reputable bank. Make sure it's FDIC insured. That way you're protected, but at least start earning some interest on your savings. But there are 4 different categories of assets that you can consider converting your money to. That way now not only can you protect your money against high inflation, but you can also benefit from inflation. Number 1 is by investing your money into your own income. Number 2 is by investing your money into passive assets. Number 3 is by investing your money into more of active assets. And number 4 is by investing your money into more of protectionary assets. Let me start by talking about investing your money into your income. Your income and your expenses will ultimately determine how much money you have left over to be able to invest in other assets. And for this particular income topic, I'm not talking about the income you get from your own business, but if you're working a job, meaning you're working inside of somebody else's asset. Because if you're an employee in a business, well, somebody owns that business, that's an asset for them, but you are a piece of that business. Now, the first thing you want to do is you want to make sure that you are a valuable part of the business. You want to make sure if you are an employee that you're able to succeed and do well as an employee, because if you do well as an employee, you're going to be the one that can get the most raises, the most promotions, the most bonuses. You want to make sure that obviously you are working somewhere where you have the ability to succeed and see more of that upside. So you want to be working to invest in your income. How can you increase your income? Now, this might be you going out and getting a certificate if you're not happy in the career that you're in. This might be you working to get a promotion or to get a raise. This might be you working a second job that we can earn more income. Or this might be you working more on a commission basis, where now you have the ability to earn more money if you put in more work, something like a sales position, because now you're working not to go out and buy a car. This is the mistake that the majority of Americans make, is that they work to buy things, and then they work harder to get a raise, that way they can buy even nicer things. When the majority of Americans go out and get a raise, they have to show it off with a new car, or they have to show it off with a vacation, or they have to show it off with a bigger home. That is a guaranteed route to being broke. So what you need to do now is, number 1, invest in your own income. work to earn more money. And the reason why you want to work to earn more money is so you can have more assets. The reason why you have more assets is because your assets are what will actually make you wealthy. Your savings are not there to make you wealthy. Your savings are there to protect you against an emergency, or you can use your savings to go out and buy investments, buy assets at a discounted price, or just buy assets in general. You're saving money to buy assets, or you're saving money to protect you. You should not be saving your money to become wealthy. That's not what your savings are there for. So now, when you're working to earn more money, what's the reason why you're working to earn more money? It's so you can buy more assets. Because now if you can buy more assets, you can buy more investments, you can create more cash flow, or you can have more wealth, which will then be able to fund more of your lifestyle. So if you want to have a bigger lifestyle, great. I want you to have the nice things. But you want to make sure you can do it the right way. Most people make money to buy nice things and then wonder why they're always broke. Wealthy people make money to buy assets and then let their assets pay for the nice things, and then they never have to worry about money because they own the assets which continue to produce an income for them even when they're not working. The second type of asset that you want to own to protect you against inflation are passive assets. Now, the thing that I want you to understand here is that inflation can be a double-edged sword because on one hand, when you have low to moderate amounts of inflation, that causes the price of assets, things like stocks and real estate, to grow because, well, when you have inflation, that means people have to pay more money for rent. That means people have to pay more money for their groceries. They have to pay more money for their things, which means that these businesses and the landlords make more money. So on one hand, and the low and moderate inflation, that benefits the asset owner. But then when you have too much inflation, that comes back around to bite you because then if you have too much inflation, that means that people no longer have the ability to spend because they have to pay so much money for their rent. They have to pay so much money for their groceries and their gas and their travel that now they have limited leftover money. And when people have limited leftover money, that can then contribute to an economic slowdown or a recession, which then hurts asset prices. So you have to understand that inflation in general is good for assets, things like stocks and things like real estate. But when you have too much inflation, that can come back around to then hurt those same assets. But understand that in general, inflation is good for these assets. So I want you to understand that, and nothing works in a vacuum. Nothing goes up or down linearly just based off of one other factor. There are so many factors that impact the prices of things. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Now, the two main types of passive assets that I want to go over are stocks and real estate. Stocks are much more accessible for people. Real estate is less accessible. It takes more money, it takes more time, it takes more capital. It's fair. That's just the way that it is. Now, you can do one or the other, regardless of where you are. You just have to set your mind to whatever it is that you want to do. So I want to start by talking about stocks as a passive investor, and then I'm going to talk about real estate. Now, when I say passive investor, the reason why I'm saying it this way is because this is not something that you really are building yourself. Now, of course, if you are a real estate investor, you can be actively involved as a real estate investor, but it's still considered a passive investment. Even in the stock market, you could be a full-time stock market investor, but you're not the CEO of the companies that you're managing. You're managing your investments. You're not managing the operations. And so when I talk about being a passive investor, I'm talking just broadly stocks and real estate. I know that I talk about being an active investor in real estate and stocks, and I talk about how I'm an active investor in real estate and stocks, but that's not what I'm talking about here. When I talk about being an active investor in this video, I'm talking about managing the actual operations of that entity. And for this purpose, I'm going to be talking about your own business. But when I talk about passive assets today, I'm talking about stocks and real estate on a broad level. Now, there are a lot of different ways you can invest in stocks. For the purposes of this video, I'm going to be focusing on more of the passive side, investing in funds, because when you invest in the stock market, most people think that the way that you win is by finding the next Amazon, or by finding the next Google, or by finding the next Apple. But very, 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 very few people are going to be able to do that. Very few people are going to have the psychology to be able to hold on to an investment in the early stage through all the downturns and continue to hold on to it and make investments into it. Very few people are going to have the financial IQ to want to research these companies, and very few people are going to want to go through that type of roller coaster. Investing in individual companies is difficult. It takes work. It takes research. And it does take a little bit of luck too. But the alternative for 90 to 95, maybe even 98% of people is to invest in funds, which are now a group of companies. Because the reality is most people lose money in the stock market. But if you look historically, the stock market has gone up by 7 to 10% a year on average over the last century. Now, that doesn't mean the stock market always goes up, but historically, over the long term, the stock market has gone up pretty consistently. Yet we keep hearing about people who hate the stock market because they keep losing money in the market against these big players. Why does that happen? Because people are trying to find the next big thing, they become traders, or they just don't know how to manage the psychology of their investments. If you want to win in the stock market, the simplest way to do that, not the easiest, but the simplest way to do that is to invest in low-cost funds, whether it's an ETF or index fund, that give you broad exposure to the economy or to the stock market. Keep investing your money into it every week, every 2 weeks, or every month, and you do this for a long time. And when I say long time, I don't mean 6 months. I mean years or decades. If you do that now, you're essentially just buying a piece of the American economy. And when you're buying a piece of the American economy, well, if the economy continues to grow, your investments will continue to grow. So this is where now just understanding the different ways that you can invest your money into these types of passive investments. That way you can get exposure to this types of wealth. Now, I'm going to go over a few different types of ETFs that you can consider investing your money in. I'm not recommending any of these. Do your own research before you make any investment. I am not a licensed financial advisor. I'm just a random guy on YouTube. So do your research before you start investing into anything. But let me go over a few different examples. A few examples of ETFs that you can consider investing in are VTI, SPY, DIA, and SCHD. And as a little disclaimer, I personally am invested in SCHD. VTI is an ETF that gives you exposure to the total stock market. What does that mean? Instead of you going out and investing in every stock on the US stock market, all the major stocks, now you can invest in this one ticker symbol, VTI, and you're going to get broad exposure to the general stock market. Now, you don't have to go out and invest in all these companies and keep up with every single company. You invest in that one ticker symbol, and now you're getting exposure to essentially the United States economy. SPY gives you exposure to the S&P 500. The S&P 500 is one of the longest tracked indexes. It is the 500 largest companies on the stock market. So now, if you said, I don't want to invest in everything, I just want to invest in the big companies, well, SPY is one ETF that will give you exposure to the 500 biggest companies on the stock market. Now you're investing in the big companies that make America America, and you don't have to keep up with all 500 of these companies. You just put your money into the fund, and now you're getting exposure to the big companies in America. DIA gives you exposure to the Dow Jones Industrial Average. The Dow Jones Industrial Average is, again, a very popular index, meaning group of companies. This is made up of 30 different companies on the stock market, some of the biggest and most well-known companies on the stock market in different indexes. Now, again, the Dow Jones is one of the most tracked and most talked about indexes, and instead of you going out and investing in each individual company, you can invest in this one ETF and get exposure to the Dow Jones and now own a piece of the Dow Jones. SCHD is a dividend-paying ETF, meaning this is an ETF that people invest in for the sole purpose of investing in high dividend-paying companies. What are dividends? Dividends are cash flow. This is when a company will pay you every 3 months for doing nothing except owning that stock. So now when you go out and invest in something like SCHD, now again, you're working to create that income. You're working to create that cash flow. Now, when you go out and you hear an ETF where a stock is paying out a 4% dividend, that might not seem like a lot of money. Because if you invest $100, that's only $4 of cash flow that you're going to get over the course of a year. If you invested $100,000, you're only going to get $4,000 worth of cash flow. If you invested $1 million, you're getting $40,000 a year of cash flow. And that discourages a lot of people. But the way that you win in this cash flow game through your investments is not by making a one-time investment. It's by investing a little bit of money every time you get paid, whether it's every week, every 2 weeks, or every month. I personally love investing for cash flow, and the way that it works for me in the stock market is I'm investing every week into my dividend-paying ETFs. Every week, I'm throwing more money into these ETFs, into these assets, and then every 3 months, they're throwing more money at me. Now, every quarter when I get my dividend payout, the amount of dividends that I'm getting is growing because, for one, I'm investing more money into these dividends. Like every week I'm putting more money in there. But then number two, every time I get paid with my dividends, I'm taking this cash flow that I'm getting and I'm using it to buy more of these assets. So I'm just working to continue growing the amount of cash flow that I can get because I just want to own more of the assets. So now, what am I doing in this game? I'm working to just build and stack up the cash flow. This is one way that you can start investing your money in a passive way that you can get exposure to the United States economy without having to go out and research individual companies, without taking on all the risk, without spending all the time, without having to learn about how to analyze companies. It's a simple way for you to start doing this. And there are brokerages out there, stock brokerages out there that specialize in this type of passive investing. I've talked about M1 Finance. They have been a sponsor for me in the past. They're not currently a sponsor for me, but I am an affiliate with M1 Finance, meaning if you use my link, I will get compensated. I have a link for M1 Finance down in the description. I like them. I use them because it's so simple to use. They make this process super easy to invest into stocks passively. Again, you can find the right brokerage for you. That's just who I like. Do your own research. And if you use my link, I will get paid. All right? Simple as that. The next way that you can invest passively is real estate. And the reason why I like real estate so much is a couple reasons. Number one, I can create cash flow. Number two, you get tax breaks when you invest in real estate. But then number three, more particularly for the topic of this video, you own a hard asset. Because when you invest in real estate, you own something that you can see, feel, and touch, which creates a lot more power and a lot more opportunity, especially if you're worried about the health of the United States dollar. Owning real estate gives you something real, gives you something tangible. And if we just talked about the worst case scenario, let's just say the dollars went down the drain. People stopped caring about the value of the dollar. Well, if you own real estate and your tenants have to pay you rent and you don't want dollars, you can have them pay you in chicken eggs or duck eggs or whatever it is that you want because you own the asset. And now you can get paid however it is that you want. Now, going back to the topic of real estate, the way that it works is you're going to go out and buy a property, whether it's a condo, whether it's a single family home, whether it's an apartment complex, whether it's a duplex, whether it's an office building, whether it's a retail building, whether it's a mobile home park, whether it's a storage facility, whether it's something else, a mixed use building or anything. Your goal is to buy this property, not so you can flip it. That's what flippers do. When I'm talking about investing, it's not flipping. I'm talking about accumulating assets, owning real estate, playing the game of Monopoly. That way now you can collect rent. Every first of the month, you get a new rent check comes in. And if you do it correctly, this rent check should cover all of your expenses, your property taxes, your insurance, your maintenance fees, your management fees, your vacancy fees, and everything in between. And then put some money in your pocket even after paying your mortgage payment. That is the right way to do real estate. That's the way that I invest in real estate. Now, when you do it this way and you do it correctly, not only do you create cash flow that can be passive, it's not completely passive, but it can be generally passive if you have a good management team. But now you also can get access to a lot of tax breaks because as an attorney who's not your attorney, I can tell you that real estate has some of the best tax breaks that our tax code has to offer. These tax breaks can allow you to earn money and pay little to no money in taxes every month legally. And it can also allow you to make a lot of money on your real estate gains, meaning you buy a property for $100,000, sell it for $200,000, and pay no money on that profit today if you use that $200,000 that you just got from the sale of your property to go out and buy a bigger property. This is called a 1031 exchange. There's a lot of tax breaks that the real estate tax code offers. And that's why wealthy people love investing in real estate. So there's a lot of benefits to being a real estate investor. And when I say being a real estate investor, that does not mean going out and buying a big home for yourself to live in. This means you going out and buying real estate for other people to live in. And yes, it is difficult. Yes, it takes more money. But if you dedicate yourself, you say that you want to be a real estate investor, I can guarantee that no matter where you are financially, if you dedicate yourself to being a real estate investor, a number of years from now, you will be able to go out and buy your first rental property. If you dedicate yourself to it, you start learning about it, you start learning about creative financing, you start putting money aside for it. If you put in the work, 5 years from now, you will find a way or a solution or a path to being able to start investing in real estate and at least making your first real estate deal, but you have to get committed to that. The third way that you can invest your money to protect against inflation is to invest into an active asset. And in this particular instance, when I talk about an active asset, I'm not talking about investing in stocks or real estate actively. I'm talking about investing into your own business. Because when you invest in your own business, what are you doing? You're investing into the infrastructure that allows you to create an income. You're investing into the ability to create and build a money printing machine. Now, again, worst case scenario, what happens if dollars go to nothing? Well, now you can change what you charge for your products or for your business. And so now when you're investing in your own business, you are building an inflation hedge. Now, again, when you have a business, in general, inflation is good for you because now when inflation happens, you can raise the price of your products to compensate for inflation. If the prices of things, if inflation goes up by 2%, if inflation is 2%, and you have to raise the price of your products 2%, well, your cost will also rise by 2%, which means if you sell something for $100, your cost is $50. Your cost went up by 2%. That means it went from $50 to $51. And now you are selling your product for, instead of $100, $102. That means you increased your costs and your sales price by 2%. Well, now you pay more money. You're paying $51, but you're generating $102, which means you're effectively making a little bit more money as well. This is where now there's a lot of benefit to being a business owner. Now, again, not everybody's meant to be a business owner. Not everybody can be a business owner. Not everybody should be an entrepreneur. Let me actually rephrase that. Everybody should be a business owner if you are in America. If you are in America, in this capitalist system, you need to be a business owner, period. But that doesn't mean you need to operate a business or run a business. In fact, most people should not. You can be a business owner by investing in stocks. That makes you a business owner. But you should not be in the business of operating a business. Some people should. Being an entrepreneur is difficult. And if you want to be an entrepreneur, that can be another way for you to invest your money into your own business idea, into your own brand idea, to build an infrastructure. Now, this could be a intellectual infrastructure into the value of your business and what you do to sell products, or this could also be physical infrastructure, machinery, real estate, other places that will allow you to continue to run your operations. So when you invest in your own business, again, you're building this asset that will allow you to protect yourself against inflation and whatever else is going on in the economy. And the fourth type of asset that I think a lot of people worry about when you hear about concerns with the United States dollar are, what are the protectionary assets out there that will allow me to protect and preserve my wealth no matter what's going on out there? Now, the first one is one that I've already talked about, which is real estate. Real estate can be a great protectionary asset because, again, it's something that you can see, feel, and touch that provides a real tangible value. If you own land, you own this building, it can provide shelter to somebody and it can produce an income for you. So that real estate can be a great protectionary asset because, number one, it's tangible. Number two, it provides a very visible value. And number three, it can produce cash flow with that as well. The second one, which is growing in popularity, would be something like physical gold. Now, I own physical gold. It's not a huge piece of my portfolio. My physical gold is about 2% of my entire investment portfolio, and it doesn't really do much. My physical gold just sits there, just looks back at me. It doesn't generate an income like my real estate does. It doesn't do anything. It's just a hedge. I look at gold like insurance, doomsday insurance against the worst case scenario. For me, in fact, I don't even really pay attention to the prices of gold. I don't keep up with that. What I do is I look at gold as an alternative way for me to save money. Every month, I have a passive system set up where every month I have some cash that leaves my checking account and it's automatically going out to buy me some physical gold. Period. It's just an alternative way for me to save what I call hard money. And the reason why I personally invest in gold is because my theory is if I took $50,000 of cash today, and then I took $50,000 worth of physical gold, and I dug both of these in my backyard today, and I buried it. And then 10 years from now, I go to dig these up. I dig up the $50,000 worth of cash. I dig up the $50,000 worth of gold. I believe, my theory is 10 years from now, my gold will have more buying power than my cash. Could I be wrong? Absolutely, but this is my theory. And that's why I also have gold as an alternative way for me to save money. Now, some people also use silver. You can do your own research on silver. Some people like silver because Silver is used in a lot of applications in the world. It's used in a lot of businesses. I just buy gold because one, gold has been like that currency since the beginning of time. Everybody has valued physical gold. So for me, it's a simple way for me to get exposure to that. The third way for you to own and invest in protectionary assets is again now going to be through the stock market, this time through investing in countries and currencies that are not the United States dollar. Because in the United States stock market, in our stock market, you can get exposure to countries and currencies overseas. There are ETFs that will allow you to do this, that will allow you to invest in international countries, that will allow you to invest in emerging markets. I'll give you a couple examples. Again, I'm not telling you what to invest in, do your own research, but a couple examples are VXUS and VWO. And as a disclaimer, I personally invest in VWO. These are two different ETFs now that will give you exposure to countries and currencies outside of the United States, outside of the United States dollar. So now what are you doing? You're taking a risk. So these are higher risk ETFs, higher potential upside, higher potential downside. But now the whole idea is if something bad were to happen to the dollar, these are a little bit more protected because, well, these entities are a little bit shielded from the dollar. These are countries that, yeah, maybe they'll be impacted if the dollar gets hurt. They'll be impacted if the United States economy gets hurt, but they don't rely and revolve their currencies and their economies around the United States dollar. So now, when you create your investment portfolio, you can find different types of ETFs to invest in. Like what I do is I have 4 different general categories of ETFs that I invest my money in. Again, don't copy me. Do what's best for you. I don't recommend what I do to anybody. The first thing that I invest in, and the largest thing that I invest in, are dividend-paying ETFs. Why? Because I like cash flow. Number 2 are value ETFs. Why? Because, well, it's a kind of your more stable and safe, considered safe investment, and that also pays cash flow. Number 3 are the innovation ETFs, more risk, more potential return. I like investing in innovation. For me, it's fun. And number 4 are my international ETFs for this very reason. These are my protectionary ETFs. These are countries and currencies overseas that give me exposure to things like emerging markets, to other international countries. That way now I can invest in the businesses and the countries that are not reliant on the United States dollar. So it's an alternative way for you to get exposure and protection against the dollar. And then this brings me to the last protectionary asset, which would be cryptocurrency. Now, again, I don't recommend this to anybody. Cryptocurrency is highly volatile, highly risky. I invest in cryptocurrency. The reason why I invest in cryptocurrency is because I believe in the value of the blockchain. I think there's a ton of power, a ton of use cases for cryptocurrency. But I think a lot of people who get involved with cryptocurrency think of it as a get-rich-quick scheme, and they use it for things that cryptocurrency is not necessarily intended for. So I like cryptocurrency because I've used it before. I have people that work for me in countries that's far away. And now if I want to send them money, previously what I'd have to do was I'd have to go to the bank and send them wires. This used to be a very painful process. And yes, the bank that I used to bank with didn't allow me to send wires to my phone. So it was a big pain. I had to go to the bank physically and send wires. Well, I also began traveling a lot. And now when I would get payment requests and I was traveling, and if my bank wasn't near me, it was a big stressor for me because I hate when people are relying on me to pay them. When I get a bill, I want to pay it as fast as possible. I hate bills sitting over my head. It's just a pet peeve for me that it just really stresses me out. So now I was in California at the time. Actually, I'm in California right now too. But I was in California at the time, and there was no bank nearby me. And it created a lot of stress for me because now I had to figure out I had to go pretty far to go out and find this bank, to go in there, make this wire, and then pay my contractor. Well, then after a bunch of times of this happening, he said, hey, would you mind just paying me in cryptocurrency? Because his country didn't allow PayPal. It didn't allow Payoneer. It didn't allow a lot of different platforms. And I said, yeah, I got crypto. He said, would you mind paying me in crypto? So I went on to my brokerage. I sent him some crypto. In less than a minute, not only did he receive the money, but the fees were a tiny fraction of what I was paying before. And that was when I realized, okay, there's some real value here with cryptocurrency because it can change the way that we do payments. And it can change a lot of different things. So I like cryptocurrency for that reason. Am I advocating for you to buy crypto? Absolutely not. But you also have to understand how cryptocurrency plays a part in my portfolio. 10% or 20%, less than 20% of my portfolio, I'm getting the numbers mixed up now, less than 20% of my portfolio are what I call speculative investments. The other 80% are more of the proven investments. So 80% of my portfolio is real estate and stocks. The bulk of my real estate portfolio and my stock market portfolio are primarily for cash flow. In fact, all of my real estate investments are for cash flow, but the bulk of my stock market investments are for cash flow. That's 80%. 2% is physical gold. That leaves 18%. But in there, that 18%, these are what I call my speculative investments. This is where I invest in things like startups, and this is where I invest in things like cryptocurrency. So now, if cryptocurrency went down to zero and I lost all of my cryptocurrency investments, would it affect me? No. But I also believe in the value of the blockchain. I think there's a lot of upside, which is why I invest in it. If you are going to invest in cryptocurrency, you have to be willing to accept that risk. You have to understand the volatility of cryptocurrency, and then you have to know why it is that you're investing in it. So understand that for what it's worth. And again, this also creates another potential protectionary investment, but I'm hesitant to say that just because of how new cryptocurrency is and how volatile it is as well. But it is a way to diversify your money away from some of the traditional investments. Now, I want to kind of circle back to what I was talking about in the beginning of this video, which is Warren Buffett. And I know this is a little bit after his annual shareholder meeting, but I want to talk about some of the things that he said because it's very relevant to what we're talking about right now. Warren Buffett, in his most recent annual shareholder meeting, talked about 5 key points. He talked about number 1, that cash is no longer trash right now. He said that 2, that the banking system is safe. Number 3, that there's going to be a big opportunity coming for you to invest your money. Number 4, that there's no other reserve currency like the United States dollar. And number 5, he talked about artificial intelligence. And let me start by talking about number 1, which is cash is not trash. Warren Buffett and his entity Berkshire Hathaway are sitting on their largest cash pile ever with around $100 billion worth of cash. Now, he's been criticized a lot over the last number of years for sitting on all this cash, especially through all of this inflation. And now what he's talking about when he says cash is not trash is that he finally has the ability to earn some interest on his cash. And the way that he's doing that is by keeping this cash in treasury notes, treasury bonds, treasury bills, where he earns some return on this cash. Now, what does that mean for you? Well, if you have excess cash sitting around, you can finally generate some sort of interest. How can you get this interest? Well, again, you can lend some of this money to the government through treasuries. This is what Warren Buffett is doing. And you can also consider investing some of this money, or not investing, but saving some of this money into a high interest savings accounts, which are now paying somewhere between 3.5% to 5% in interest on your savings. And again, you want to make sure that if you are putting your money into a high interest savings account, that you're doing the research on which bank you're keeping your money in, that is FDIC insured, and that it's a reputable bank. That's what you have to make sure of, because FDIC insurance only protects you up to so much, and you never know what the government is going to say if we see more bank failure. So just protect yourself and make sure that you're keeping your money into a reputable bank. But at this time, with interest rates rising, you can get higher returns on your cash, which is where now Warren Buffett is saying, hey, I can get a pretty decent return on this cash as I wait for a good opportunity. And I'm going to talk about his opportunities are coming in just a second. The second thing that he highlighted is that the banking system is safe. Now, we have been covering what's been going on in the banking sector. It started off with Silicon Valley Bank. We saw it now recently with First Republic Bank. There's been a lot of craziness in the banking sector, and it's still not done. There's a lot of issues with regional banks. Regional banks kind of got a big check, or a big I don't want to say bailout, but a big raft, a big life jacket from the Federal Reserve Bank. I'm not very good with these analogies. Where the Federal Reserve Bank essentially opened up a huge lending program for regional banks that they could borrow billions and billions of dollars directly from the Federal Reserve Bank. That way they continue making their operations. Now, the concern with this is, yeah, it helps them stay in operation today, but all this debt is going to weigh in on their costs because they're going to have to pay this money back plus interest. And at the same time, we've been seeing a huge amount of outflows of cash from these banks because people naturally have been worried about what's going on with regional banks and the smaller banks. And so they pull their money out of these banks, going to what they feel are safer banks So that means these banks are, number one, struggling to make more money because they don't have the money to keep lending like before. And then number two, their expenses are also rising with all these new loans from the Federal Reserve Bank. But this is where Warren Buffett says that the banking system is safe, and not just that the number of bank failures are going to slow down. That's not what he's talking about. What he says is that with the promises by the government, your money is safe in the bank. And he wanted to emphasize that because, it's a crucial part of our economic system. If people don't feel safe saving their money in the bank, our entire economic system is going to implode. So, it's very important for the government to make sure people feel safe keeping their money in the bank, because without that, we don't have an economic system. But one thing that Warren Buffett did highlight is that while depositors should and will be safe in banks, the investors in banks might not be protected or won't be protected the same way, because if we see more bank failures, which is very likely, the investors, the owners of those banks, will not be bailed out. The government has kind of made that commitment already that they're not going to bail out the shareholders of the banks. So the depositors, the people that save their money in the bank, should be protected. But the owners of the banks, if the bank fails, well, that's part of the economic system. You might not see another penny. Now, we've been covering the entire banking sector in Market Briefs, which is why if you have not joined Market Briefs, make sure you do so. Because if you want to stay up to date with what's going on, not just with banks, but with the economy, that we're not blindsided by things, Market Briefs is there as a free resource to keep you up to date when it's happening. It's a free newsletter where my team is breaking down what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. The third thing that Warren Buffett talked about is that opportunity is coming. This is why he's been so adamant on accumulating this big cash pile, because he believes that we're going to see great opportunity to invest money, aka distressed assets, aka falling investment prices, which will create good opportunity for him to buy. Now, what's funny is when he was asked what creates this opportunity, what he said was that it is other people doing dumb things. When other people do dumb things, it creates opportunities. What are these dumb things? Well, it could be people over-leveraging to buy investments like stocks that they don't understand. And then if that stock price goes down, they'd be forced to sell a lot, because now not only did they lose out on their investment, but they also lost the debt, which then can force more panic selling, which then can create good opportunities for people with money and with the education to come in and buy. We saw it happen with real estate when people buy too big, and if they get foreclosed on, now it can again create opportunities. So what Warren Buffett's saying is that when dumb people do bad things with their money, it creates opportunities for people who have money with that financial education. And the second thing that he did highlight, though, was commercial real estate for this instance. Now, I've been kind of hinting and talking about commercial real estate quite a few times now, but the commercial real estate market is going through a huge shakeup for a couple reasons. Number one, about half of the almost $3 trillion worth of commercial real estate loans are set to readjust in the next 24 months. And when I say readjust, that means the interest rate will readjust. Why? Because commercial real estate loans are not 30-year fixed rate mortgages. So we're going to have $1 trillion+ with the commercial real estate loans that are going to readjust in the coming 24 months. Well, interest rates now are significantly higher than where interest rates were 24 months ago. So now when you're a landlord sitting on a commercial property and interest rates are significantly higher and your loans readjust because they have to, it's not a 30-year fixed rate mortgage, it readjusts. Now the bank's going to come back to you and they're going to increase the heck out of your monthly payment. Now, if you own an apartment complex that's 100% full, okay, not too big of a deal. You got to raise the price of your rents and, you can get by with the higher payments. But what if you are an office landlord sitting on a building that's half vacant and now your expenses doubled? Now you can start to see where the big problem is, because we still have a lot of office landlords that are sitting on these vacant properties. And now if your expenses start to shoot up because your debt costs are rising, that's going to put a lot of pressure on landlords to either A, get more higher paying tenants into the property, or B, get rid of the property as fast as possible. And if we start to see more liquidations of properties, that means more inventory hitting the market. If we start to see that, that could pull the price of commercial real estate lower. So that's kind of the concerns that Warren Buffett even highlighted. And we've seen a lot of banks and institutions highlight their concerns about the commercial real estate market. But we're going to see the real impacts of this in the coming years. So that's something you might want to keep your eye on, especially if you're a real estate investor. Number 4, when it came to the topic of the dollar and the concerns about the dollar and inflation and countries around the world trying to distance themselves from the dollar, what Warren Buffett emphasized, which is very important to understand, is that right now there's no competition for the dollar. There's no other currency that can compete against the dollar, which is 100% true. But then Warren Buffett also went on to quantify that by saying that once you let the genie out of the bottle, and in this case, genie is the inflation genie, and people start to lose faith in the currency, it's very hard to put the genie back. It's very hard to get that faith back into the bottle. And what that means is if we continue to see very high inflation, that is going to cause people to lose faith in the dollar. And if we see more and more countries distance themselves from the dollar, that is a very bad trend. So yes, today there are no currencies that can compete against the dollar. We are the strongest dollar, we are the strongest military presence, the strongest government, the strongest economy. There's nothing that can compete against the dollar. However, if we continue down the trajectory that we have right now, we could see major changes with the world order in our lifetimes. And this is where Warren Buffett kind of reassured people, hey, we're okay today. But if things keep going down the path that we are right now, it could get worse, and this is where you want to make sure you're protected. And again, being financially educated as well. And then when it came to the topic of AI, let me read you directly what Charlie Munger said, who is Warren Buffett's right-hand man. We're going to see a lot more robotics in the world, but he's still skeptical of some of the hype in artificial intelligence. Essentially what he's saying is you can expect a lot more artificial intelligence to happen, but you might also see bubbles along the way, which is a very interesting statement by Charlie Munger and Warren Buffett, especially if you understand their backstory, because they've also been very anti-technology for a very, very, very long time. Warren Buffett and Charlie Munger like to invest in value opportunities where you see the amount of cash flow that a business is making with a good product, with a strong moat, meaning inability for other businesses to come in and compete. Those were the types of companies that they invested in. Technology kind of really shook that up. And so while they might have missed some of the technology opportunities, they still made great returns on their investments. And now what they're saying about artificial intelligence is, yeah, this is going to shake up things in the economy. But it also comes with a lot of hype. A lot of hype also comes with big bubbles. And what do bubbles do? Well, they burst. So this is where what he's kind of hinting at is you want to be smart, especially if you're considering investing in things like artificial intelligence. Avoid the hype, avoid the emotion, and really understand what it is that you're investing in. This is where now I want to circle things back to inflation and our economy and talk about the concerns that people have right now of stagflation. Right now, inflation has fallen off of its highs, but it's still way higher than it should be, while at the same time, our economy is slowing faster than people expected it to be. This is why now we're seeing more and more people get worried about the potentials of stagflation. Right now, today in our economy, we are seeing high inflation and a slowing economy, which are two of the three parts that make up stagflation. The only missing piece of stagflation right now is high unemployment. What stagflation is you can think of it as rising prices and lower wages because people don't have jobs and the economy is slowing. And the last time we saw this type of stagflation was in the late 1970s, early 1980s. And it's a very tough mix of things to heal because now not only are the prices of things rising because of inflation, but then people's ability to buy things is falling because people are losing their jobs and wages are falling. That's why stagflation has always been such a big concern for people ever since the inflation problem started post-pandemic. But this is where now understanding, are we going to see stagflation? How do you protect yourself against stagflation is so important. Right now, our unemployment rate is still low. Our recent unemployment data tells us that we are still at the lowest unemployment levels that we have seen in more than 5 decades. But things are flipping pretty fast. We've seen a handful of bankruptcies, but the bigger concern isn't the bankruptcies that we've seen, it's the rate at which bankruptcies are accelerating. Just like that, we've seen layoffs across multiple different sectors, but the more concerning part besides the layoffs that we've seen is the rate at which layoffs are accelerating right now. This is where you want to come back and look at what some people call the triangle of doom, which is what we are going through right now, where on one corner we have high inflation. This high inflation is making life difficult for people because, well, yeah, inflation has fallen off of its highs, but it's still there, which means the prices of things are rising, which means the money that you're making today can't buy you as much as it could have just a few years ago. So people just can't save as much, they can't invest as much, and they have to spend more money to be able to live their lifestyle. And inflation is still around, meaning that 12 months from now, we could be in a worse situation than today, assuming inflation continues to stay high. And right now, inflation hasn't really made significant strides recently to come down. So the high inflation is causing pain to the economy, which is also slowing the economy because the high inflation means people have less ability to spend on other things. The second corner of the triangle is the higher interest rates. See, the Federal Reserve Bank is seeing this pain in the economy, and what are they doing? Well, they're working to raise interest rates in order to bring inflation down. Now, this higher interest rates are a way for the Fed to cool demand because when you raise interest rates and mortgage rates go up, less people want to go out and buy a home. If less people are going out to buy a home, that reduces the demand to buy a home, which helps cool the speed at which home prices are rising. Now, the goal with higher interest rates isn't isolated to the housing market. It's supposed to impact every different part of the economy because people are less likely to get a home equity line of credit and spend money. People are less likely to go into credit card debt and spend money. So the goal with higher interest rates is to slow down spending in general, to cool demand, to cool the prices of things rising, but it comes with a consequence. The higher interest rates also cause pain in the economy. It slows down the economy. And we're facing this at a time where interest rates have gone up significantly over the last 18 months. We've seen interest rates rise from essentially 0 to over 5% in the last 18 months, which is some of the fastest rates we've ever seen interest rates rise. And it's never really been done before where we've seen interest rates rise this fast without causing some sort of economic slowdown or a recession. So now the higher interest rates are also causing a recession, and this is one of the things that we've also been covering very deeply in Market Briefs, my daily financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so because it's a free way for you to stay up to date on what's happening with things like interest rates and the Fed and the economy, the housing market and the stock market, that we're not blindsided by anything. It's completely free. It's an easy to read email. So if you haven't joined Market Briefs and you want to stay up to date on what's happening, it's free, and I got the link for you down in the description below, or you can also go to briefs.co/market. That's briefs.co/market. And then the third part of the triangle is the slowing economy and the higher unemployment. Now today, we are still seeing some of the lowest unemployment levels ever. Now there's, a lot of things that can be said. People are talking about how the way that we measure unemployment is false and this and that. And sure, that's all true. But on a general level, people have jobs. Are they making as much as they would like? Maybe not. Are people at all the jobs that they want? Maybe not. But jobs are there. But you have to also understand what is going on with the job market. Why are all these jobs there? Because if we kind of backtrack and we go back to what happened in 2020 and 2021 and even into 2022, we saw the most amount of money printed ever. We saw the lowest interest rates ever, which means we saw trillions and trillions of dollars of money injected into our economic system. Some went to people, some went to businesses. But businesses saw this huge influx of cash, which meant we saw a huge surge in the need for labor. And this is all kinds of labor, manual labor, skilled labor, all kinds of labor. We saw this huge need for labor along with the demand because when people got more money, they needed more things. When people got more money, they wanted to spend it. And businesses wanted to invest in their businesses. So when you create the lowest interest rates ever and you inject billions and trillions of dollars into businesses, what's going to happen? Naturally, businesses are going to grow very quickly and they're going to create a need for labor. That's what we're seeing right now. There's a shortage of people. Businesses need people, but there's not enough people out there. And the reason why is because of how much money we created in the last number of years, injected this into the system, and now businesses are trying to keep up with that. And this is where we're going to see a balance happen. As the Fed works to now increase interest rates, it is going to reduce people's ability to spend. It is going to slow down spending. As spending slows down, businesses' revenues are going to slow down. And as businesses' revenues slow down, we're going to see more and more businesses downsize to be able to now mitigate their way through this economic environment. And as businesses do that, you're going to see a lot of changes in the job market. So yeah, right now we're seeing extremely low unemployment. We're seeing some of the lowest unemployment ever. But what got us here? We had a lot of money out there. And when you're given that much money, when you're a business and you're given huge sums of money, you're going to want to use it to grow your business. You're going to want to use it to grow your infrastructure. You're going to want to use it to hire more employees. Well, now we're seeing the downsizing happen. And as interest rates rise, to cool down inflation, it's going to continue this downsizing effect, and that's going to continue going on. And now this is where, well, how long is this going to continue? Well, I was reading a report actually in Market Briefs where my team was writing it down, noting it that the general time frame to see the impacts of higher interest rates are 18 months. 12 to 18 months it takes to see the impact of higher interest rates. So where are we today? We're starting to see the impacts of last year's interest rate hikes. Next year, we're going to start to see more of the impacts of this year's interest rate hikes. So we are working to raise interest rates to cool down inflation. The interest rates rising have brought inflation down, but it has not brought inflation down low enough. That's why we're still seeing the Federal Reserve Bank saying that we might need to continue raising interest rates aggressively because inflation is not coming down fast enough. Inflation is still high, which means not only is it less likely for the Fed to start cutting interest rates, but we might even see higher interest rates. So as interest rates go up, borrowing goes down, which slows the economy more. And so now it comes back to the triangle. We'll still have high inflation. Hopefully it'll come down more. But we have to bring inflation down, because if we don't bring inflation down, that causes all the other issues in the economy and the currency that I've been talking about, where inflation is a much bigger issue to tackle than a slowing economy. So inflation is still a major issue. Then we have the higher interest rates, where it looks like interest rates are going to have to go even higher. If the Fed pivots and starts cutting interest rates sooner, then you can make the inflation problem even worse. If you start cutting interest rates, you can stimulate the economy quickly. You can create an economic boom, but that's going to cause the inflation problem to get worse. Then that brings us to the third piece, which is the high unemployment, which we don't have right now. We still have low unemployment, but we are seeing the economy slow down. After the most recent United States economic report results came in and said that our GDP slowed down way faster than expected. So yeah, we are seeing the economy slow down. What does that mean? Businesses are making less money. If businesses are making less money, they're going to have to find a way to change that. How do you do that? You can sell more stuff, make more money, sell it at a higher price, or you can cut your costs. Now, when you're going through a slowdown where people are struggling to spend because of the high inflation, it's much more difficult to raise your revenue because people have less money to spend. People have to spend more money on their housing, on their groceries, on their travel, and everything in between, which means there's less money left over for them to spend. If businesses have less money left over to spend, or people have less money left over to spend, that puts businesses in a tough situation where they will be forced to cut costs. How do you cut costs? Well, one way to do that is layoffs. And this is where a lot of people have a very short-sighted view of the economy. But this is where I want you to understand, as a financially smart person, there's a lot of red flags out there. And this is where it pays for you to be, one, aware of what's happening, but then also take action. And what does that action mean? Well, number one, that means 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. 2023 is the year for you to now put aside some money to do two things. Number one, protect you against an emergency, build that savings cushion. And then number two, build that savings to be able to capitalize on opportunities that might come your way. Because if we continue to see more opportunities, if we continue to see more pain in the economy, that's going to create more opportunities for you to go out and invest in distressed assets at a discounted price. And number three is focus on being prepared. That means investing in a financial education, learning how to invest. There's a ton of free resources out there. There's a ton of YouTube channels out there. There's a ton of blogs out there. There's a ton of books you can read on learning how do you invest. How do you find a good investment? How do you invest in stocks? How do you invest in real estate? How do you invest in businesses? There's so many ways for you to invest, but you have to start doing that, because if things continue down the trajectory that we are now, if we continue to see higher interest rates, that is going to pull down the economy, and we're going to see big changes. No one knows when, but we're going to see big changes happening in the economy. And this is where you want to make sure that you're not blindsided by it, but that you have the ability to capitalize on it. And the only way you can do that is if you're prepared and financially educated. And they go hand in hand, because you can have all the financial education in the world, but if you don't have any money to go out and actually capitalize on an opportunity, you can't buy it. And this is where you want to make sure you're smart with your money today. That way you can capitalize on opportunities that might come your way in the future. Everybody is holding their breath in the economy right now. It feels like every week more and more institutions are coming out and saying or forecasting a recession is coming in the economy, which brings up a tough question. Should you begin investing today, or should you wait for markets to crash and then come in and buy at a discounted price? And the reason why this question is so difficult